Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 28th, and welcome to this week's In the Know Trader Show. What do we have on tap? Well, in our trader education portion, we'll briefly talk about whom do you want to align your positioning with. In our sector macro overview, we'll take a look this week at semiconductors. So we'll take a look at the SMH ETF, which is probably the most predominantly traded ETF for semiconductors. We'll look at it relative to the XLK, the technology sector, and we'll look at semis versus the S&P itself. And then we'll go through as many of these top names in the semiconductor holding. These are the top holdings in the SMH, starting with Taiwan Semi. And we'll go through as many of the individual charts as we can. As far as products that I have, go to intheknowtrader.com to sign up for my weekly ETF Tactical Trader Report or the monthly 7-Eleven Spider Sector ETF Report. And of course, that latter report, which comes out once a month and will be very shortly out with a new one in a couple of days as the month of June ends. Here, what we do is allocate to the using the Spider macro sector ETFs like XLK, XLE, XLF for financials. And so we put no more than 7 of the 11 Spider sector ETFs on in any given month with the goal of outperforming the S&P by avoiding the non-performers. And so far, this is through May 31st, this is how we're doing. So year to date, we're up by 334 basis points over the S&P. And that's not even halfway through the year. We're outperforming in our fiscal year by 437 basis points. Our fiscal year starts every August 1st. And since we started this 22 months ago, almost 23 months now, in August 1st of 2020, we are outperforming by 698 basis points, which is just a huge amount in the money management industry. As I've said to you before, if this was an actively traded fund, this would put us in the top 10% of all people who manage money. And so for those of you who have money in spiders, for those of you who are financial advisors who put clients into passive investments like spiders, you would really want to consider subscribing to the 7-Eleven report if you'd like to do and make more than the spiders. The other thing I was going to tell you is that I am starting my own In the Know Trader YouTube channel very shortly. And please now go ahead and sign up. We've already put one video up there. Go to this link, https://bit.ly/3ZUJZTO. And that is the link to the site. And I will very shortly be doing these webinars on my own YouTube channel. So please go and sign up now for that. The more people who sign up, the better chance it'll be that I will continue doing these shows. All right, let's take a look at how the market's doing year to date by looking at the S&P sectors. And I switched this from month to date to year to date because we're just about done with half of 2022. And so we get a sense here. If I were to draw a horizontal line, the S&P's return, the spider's return is on the far left. So if I were to draw a straight line across here, you'd see that 4 sectors very closely have matched what the S&P has done this year. Industrials, materials, financials, and real estate all are very close to the same return of the S&P. The outliers are consumer discretionary, communication services, technology. These are underperformers. And of course, the outperformers are the 4 in here, with energy being the only name that's up this year. And despite the fact that it has gotten clobbered recently, it's still up 35% with a down 17% S&P. So spectacular sector to be in. We have been overweight energy the entire year in the No Trader. In fact, for much of the year, we've been in staples. last December 1st, I went into healthcare for the first time since the 7-Eleven report started. So that was a phenomenal new move to get into. We are long utilities also. So we have a couple other sectors in here, but part of the reason we've done so well and outperformed is because we have properly played energy and got defensive enough to get into some of these defensive sectors earlier this year to avoid getting, the big losses. So that's, this is kind of what the picture looks like as we go into the second half of the year. All right, let's talk just briefly about whom do you want to align with your positioning. And I say this as a very important topic because I want you to think of your answers to the following questions. If we were in a seminar together, let's say I was putting a presentation, I'm standing in front of the room, and I'd ask participants to raise their hand if they use, let's say, the RSI indicator. I would assume that your hand would go up as well as would most of the participants. If I said, how many of you use moving averages, your hands would go up. How many of you use Bollinger Bands? Most of your hands would go up. How many of you use other oscillators like stochastics or even a MACD indicator? Most of your hands be up for most of these questions. And many of those are the basic tools that a technician uses, along with bar charts and trend lines and maybe candles and some other things that make up your toolkit. But here's the important thing you should know as individual traders. What you're looking at is not generally what institutions are looking at or using to make important decisions about their portfolio buys and sells. And I think this is very important because what you've been taught in the technical analysis arena is all fine and good, except the biggest flows from the biggest firms who have the biggest impact on the markets aren't generally using those tools to make their decisions. And therefore, you're most likely more aligned with what individual traders are doing as compared to what institutions are doing. And I think that you'd want to align yourselves as best you could with what institutions are doing, because they're the ones who really drive the market directionally. Now, you could say that if you were trying to take advantage of the meme names and you were trying to squeeze the institutions that were short last year, you might have had a quick bout of success collectively as individual investors trying to take on institutions. But in general, you want to be aligned with what institutions are doing, especially if it's the long side of the market and institutions are buying. You don't want to be selling. You want to be generally going with where the big money is going. And the reason I bring this up is the tools that you're using generally don't do that because the institutions aren't doing that. And it is why I have spent virtually my entire time with you doing these webinars for 3.5 years, these In the Know Trader shows each week, is because I'm trying to teach you to get aligned with institutions by using and showing you models that they use as compared to, oh, RSI is oversold, I guess we should buy. It doesn't work that way in the institutional community. Stochastics are overbought, let's sell. No, generally in an upward trending market, when you get overbought, you often are at the beginning of a whole nother leg higher. So as I start my own YouTube channel and have hopefully most of you, if not all of you, start following me on my channel, I will continue to show you as best I can with over 40 years experience in the industry with some of the most prestigious jobs and firms on Wall Street, which is my background, why you want to be aligned with what institutions are doing. So when I show you the models that I typically do as we go through, and we'll go through, our charts and other things that we have today, it's because this is what institutions look at, and this is what helps them make their flows in and out of the markets at the time and places they choose to, not most of the general technical indicators that people look at. So I hope you can appreciate the fact that what I'm trying to do is get you to align with what institutions do as compared to individual investors. And that's why I use the models I do. And I've myself have taught so much of the institutional community these models. These are the more important models as compared to the basic things that most technicians that you might hear or follow use. It's all good and it's all fine, except that it's not what institutions use. So put that into your formula of how you want to look at the markets going forward. All right, let's take a look at semiconductors this week. So we'll start by looking at SMH against technology and SMH against the spiders. So we're going to flip to our charts, and we're going to start with the SMH bar chart, or in this case, candle chart. And notice that we've been selling off in a straight channel this year. We have yet to retest the top of the channel. We got close a month ago, didn't quite get there. We came down, touched the bottom again, and are in the midst of some type of rally. Most importantly to look at is the fact that on the lows, this is very similar to the S&P weekly chart. When we made the low, the lagging line was right here against the bottom of its cloud. In fact, it just dipped a touch beneath intra-week, but has stayed above. And this is what's provided some of the bounce of the market, not just in semis, but in the S&P itself, is the fact that the cloud's lagging line held the bottom of the cloud. And obviously, with the dramatic 350 point or more rally that we've seen, not 350, I'm sorry, 250 right now, and probably close to 300 on the peak. That's a pretty big move in the S&P off of the lows, and it's because of this model and what it showed in the S&P on the bottom is why we've gotten the bounce we have. And again, why I've spent time with you showing you cloud charts, trying to have you understand them and incorporate them, is because this is something that institutions care about, far more so than, let's say, if I put up an RSI chart, which doesn't help all that much. So semis are bounced. They've bounced where they need to. First resistance is going to be up near 225, where the conversion line is. If you can get above, what's this level in here? Looks like about 226 or so. If you can properly get above there, that's the propulsion, that's the bullish propulsion level. Then you have a chance to come back and get to the high end of the channel, if not even a little bit higher. So right up in the mid 220s is really the transition point right now for semis. And if they can hurdle it, then this thing's got a fighting chance. If not, it's just another rally that needs to be sold into, and you still have overall weakness, but at least we know for now the overall weakness held where it needed to structurally to still have this in some sense of a bull market, even though price is underneath the cloud. Let's take a look at SMH against XLK to see in relative performance to its own group. You can see that here, if we go all the way back to, let's just take a look here. So these highs back in 2017 pretty much caught the bottom in 2021. We dipped beneath it, came right back strong. And so right now, look, we're kind of in a trading range of this. Oops, that's the wrong line. Hold on a sec. We're in a trading range from double top here, almost triple top, into double to triple top bottom. It's hanging in here. Next move down probably gets you to where it broke out from back in the middle of 2020. So you could still have some further to go. Bounced on a 9, but you have an incomplete 13 here. So tough call, other than it's still the sell on rally type candidate. That's again versus the XOK. So that's just semis versus technology. Let's take a look at semis versus the S&P before we get into the individual names. Price broke through the cloud, lagging line broke through the cloud for 1 month, shot right back up, and we've pulled back. Now we've pulled back through the lagging lines through again. So certainly new lows would suggest further declines down to at least target here of 0.53, meaning that the price of the SMH is 53% of the price of the S&P right now. It's about 55% of the price of the S&P. Resistance against the trend line, and then next level up would be about 59.7% of the S&P. So tough call here, trading range environment. You could make the case that this would make new lows. Too early to quite call it, but if we make new lows, you at least would look for it to get down here. On a much bigger correction, if they totally decimated the semis, then you're talking about a move all the way down to like 48, 49. I'm sorry, what is that? 47% or so of the S&P. So that's kind of relative performance, because you want to look at it both in terms of how it's doing on an outright basis, but also relative. As we're talking to, the market's made new lows. S&P futures now down 37 on the day. So right after the open, they were up substantially. The high of the day in futures was 39.50. They're now trading 38.64. So we are 85 points off of today's high. So we have given back all of the morning rush in that saw investors kind of like the fact that China is opening back up. Let's take a look at, we've got a bunch of names to go through here. We're going to start with Taiwan Semi, the highest cap name here. Look, all-time high, sequential 13 on the weekly chart, double top, obviously, versus the highs from January of 2021. So full double top, took out the bottom, full breakdown here. Let me just see if I make the count go faster, how close we are. So that's on a 9 towards a 13. And let me look at aggressive. And we're on a 12 towards a 13. So at least we know, oh, look, and this, so the same way of counting using aggressive combo, a sister model to sequential, is potentially only a week or two away from getting its first 13 on the downside. Last time it had a 13, you see it was a major top. So probably a little too early to do buying yet. And you see that the conversion line acted as resistance in Taiwan Semi on the last rally up. So you've got to kind of get through there to establish any type of bottom. So we're getting closer, but probably not there yet. NVIDIA, better looking chart in the sense that the lagging line has not come through its cloud. It's bounced on it. It's in conjunction with the 13 that showed up about 5-6 weeks ago. But you're still getting weakness. And we're close to, if we close the week, it's only Tuesday, but if we close the week here, it would be the second worst close of the year. So this is still very questionable. You don't want to see the lagging line really come through the bottom of the cloud. Otherwise, that opens up the door for NVIDIA to get down to 125-ish. All right, so here's Texas Instruments. Not a good looking chart at all. And notice too, that this is kind of where we broke down from, right? In the low 160s, that should put a heavy wall of resistance above us going forward. You're in no man's land here. Next support down at 138 and change. This is sell and rally candidate here. Anything north of 160, I'd be a seller here, and you'll be joined, or should be joined with lots of other people. So not a good looking name at all. Let's take a look at Intel. Intel, far worse. I actually have to bring in a lot more data because of how bad this is. Let's just call it anywhere from 42.5 to 45 is where this broke down from. It did get a 13 signal. It had a quick bounce from it, but and then recently we've kind of tested near the stop out level. I mean, this could be, you know, if you love the name, it's a trading bounce, but I wouldn't expect this to easily get through the low 40s for quite some time to go ahead of now. So it's not a great name at all. And support now down near 35 or so. ASML, not a good picture. Clouds broken through price, lagging lines broken through price. You've got nothing count-wise to suggest downside exhaustion. Let me put propulsion in here and just see if that gives us any levels to look at. Well, there are a few down in there, but structurally, this could easily break under 375. I mean, this has potentially plenty of room to go on the downside. Let me look at, I don't see really one real breakdown point, but I put it somewhere in this neighborhood here of some lows and some highs. So, you know, let's call it resistance at kind of 580-ish. These are big numbers, you know, these are $100 moves in between, but nothing really good here that I can tell you right now looking at that chart. Broadcom, AVGO, better than some of the other charts in the sense that only price has broken through the cloud. The lagging line is still well above its cloud. It's kind of in no man's land. Going forward, should have pretty stiff resistance near 550. And support at this point, if we take out the lows, I might very well expect this to trade down enough to come to the top of the cloud at 466-ish. So you're in no man's land right here. And I would be a seller on rallies. Qualcomm just broke its cloud, and the lagging line broke its cloud, and it's being topped by the conversion line here. You can see multiple highs this year failed against the conversion line. There may be some resistance here as the lagging line comes and touches back against the bottom of its cloud. If we take out 115-ish, then you're talking about 104 and change as the next target. So still a heavy name going forward. If this ever recouped and turns around, anything in the mid 150s is your exit. And then, you know, I'd probably say goodbye to the name. AMD. So cloud, like many cloud, we're through the cloud, prices through the cloud, lagging lines still holding on. You see there's a TDST line here that's acting as support for the last few weeks. If that gives way, then it opens the door for a move all the way down to maybe 60-ish. And of course, at that point, your lagging line is through the cloud. The only thing it possibly has as a saving grace is that we're on 11 towards a 13. So in a few weeks, you might get a bounce, but all depends on how that comes versus what the lagging line does to its cloud. You know, tough name. You got to get above 102 and stay above 102 to give any sense that this is turned around. But even if you do, it's going to have resistance from 115 to 125. So a lot of these end up being in trading ranges, and probably going forward in time, you need to trade the trading ranges. Okay, that's my timer saying we have time for one last name. So we will do, let me just look at the remaining names and see what's my guess is the most popular that people are probably in, and I'm going to pick Micron. So here's the chart of Micron, right? It's broken its cloud, lagging line, tried all these closes in here. We're trying to hold on. Once it broke a month ago, boom, it's gone. It's gone to the stop out level from this 13 all the way back in August of last year. It's holding there. As long as it's hold there, it's okay. We get a couple of Friday closes beneath 56 and what is that, 55.58. Then it opens the door for a move to 44. Resistance first at 64.5, and then about 70, 71. That is it, folks. Hope you enjoyed this week's show. Again, please go sign up for my new YouTube channel. I'm Rick Bensignor, and this has been In the Know Trader.